Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Markets in the Asia Pacific are finding some support from a key data point for China released over the weekend. Industrial profits climbed in August by 20.4% compared to last year. Now, this suggests that those national campaigns to tackle things like overcapacity and excessive competition are beginning to bear fruit. In a moment, we'll hear from Sian Fenner, head of business and industry economics at Westpac. But we begin here in the States, where the government is facing a funding deadline of October 1st. Now, tomorrow, top congressional leaders will be at the White House meeting with President Trump. They'll discuss a short-term spending bill. This is necessary in order to avert a government shutdown. And if a shutdown were to occur, that would likely delay the release of the September jobs report. It's due Friday. Bloomberg Economics is expecting non-farm payroll growth of 54,000. The unemployment rate is seen holding steady at 4.3%. For more, let's bring in James Abate. He is managing director, also the head of fundamental strategies at Horizon Investments. James is on the line from here in New York City. James, it's always a pleasure. Thank you so very much. We can talk about the labor market in a moment. You and I were speaking just a moment ago about the change in leadership for the equity market. I'd like to hear more on that. Talk to me about what you're seeing right now in equities.
You know, in a market that's richly priced and speculation rampant, I think it's always good to go back to basics and remain disciplined. If you're sitting here trying to make sense of logic and friendship, you read Aristotle. I think for me, when you're sitting here trying to make sense of what's happening in the market, it's always helpful to go back to the long-term and legendary chief market strategist for Merrill Lynch, Bob Farrell, and his market rules. And, you know, one of the key things that Farrell emphasized was investment styles. Essentially you had growth, you have value or cyclical stocks, you had small cap stocks and defensive stocks. And markets tend to rotate between styles, depend upon the stage of economic or the market cycle. I think the uniqueness of this cycle is that we have a confluence of growth and defensives. If you look at most high growth funds or defensively oriented funds, they own the same things right now. They both look like NASDAQ 100 portfolios, basically, because, you know, healthcare staples have been disappointed. They're absent in many of the low volatility portfolios and defensive portfolios. So, you know, Farrell always talked about these style distortions, and they tend to overshoot. And I think we're at a point potentially that we're seeing excesses and exhaustion. The Magnificent Seven have become the de facto new defensive stocks and safe havens, as well as the high growth leadership. So all this, leadership is emerging, in terms of potential for change, because we're at a point in time where you look at kind of the economic cycle, we're at a stage where growth is actually firming. Inflation is stable, if not coming down. All that bodes exceptionally well for a very positive economic backdrop in the United States for 2026. And from that perspective, we think we can see, a significant change in leadership in the stock market. But because we have this, so-called style distortion, it's the potential for volatility and I would say very violent kind of market action, because everybody's on one side of the boat, to really lead to, some outside gains when you see, that genuine inflection in terms of economic activity and economic growth. At the exact same time, they were finally starting to see chinks in the armor of the return on investment, the AI trade, and a lot of the shenanigans with regard to vendor financing transactions that were reminiscent of, Lucent, Nortel, Alcatel, and Cisco back in 1999 and 2000, happening again with NVIDIA, CoreWeave, and a bunch of other companies that are kind of paying to play in this type of environment.
So I'm glad you brought up the AI trade, because it was last week that hedge fund manager David Einhorn said the amount of spending on AI infrastructure may destroy vast amounts of capital. He said the numbers being thrown around today are so extreme that eventual returns are highly uncertain. I mean, this kind of dovetails with what you're talking about here. But do you have a sense of the vulnerability and the potential downside should markets begin to question this thesis a little bit?
This is a great point because, I very much agree with what he said. I've probably been a little bit earlier in saying it than he has been, because one of the things that we pointed out in the most recent earnings results for Alphabet was that for the very first time in a number of quarters, we saw return on capital and return on assets actually trend or inflect lower, meaning that despite pretty healthy sales gains, we started to see asset efficiency diminish quite greatly, leading to a negative inflection in return on capital, which for a growth stock that usually spells a very difficult environment and a derating. I think the real key is to see, how damaging this could be. And I think if you just look at some of the numbers, I mean, there's been a bunch of studies that have come out, whether it's Morgan Stanley or Bain or even some of the other consulting firms, that the volume of revenue to justify the spend that needs to be made by many of these companies is gargantuan. And the fact that ChatGPT is making promises or capital expenditure promises that are vast amounts above or multiples of what their potential revenue could be over those years highlights the cash flow shortage that they're going to have. And we'll see where that goes. But for now, people are willing to look the other way. And, these hyperscalers alone are expected to spend $400 billion in capital investments next year. I think what you have to wait and see, though, is when you see a company announce that it's increasing its capital investment on AI and the stock price has a negative reaction. We haven't seen that yet. When that happens, that's when the light bulb over every CFO's head is going to go off and rethink what they're doing in terms of capital expenditure in the AI space.
So beyond AI, I think a lot of what the market has been hoping for is aggressive easing. Maybe we get 2 more rate cuts this year. I guess critical to that story is going to be the non-farm payrolls data that we get on Friday. But you made the point a moment ago that inflation is trending lower. Is there the risk, though, that maybe it becomes a little sticky here and the long end of the curve may be a little vulnerable?
That's a potential, yes. Clearly, what we're seeing is an economy that's firming. It's not stalling, which is basically what the consensus has been. Let's remember, we basically have been in a recession or a stall type recession, not a kind of V-shaped downdraft, but a stall type recession for 4 years. So we're really coming out of that, and the tax bill has a lot of stimuli that's embedded in it that will allow us to actually grow out of basically this environment that we've been in. However, when you look at the inflation, and I'm not a Phillips curve guy, I'm not convinced that inflation and growth are a trade-off versus one another. So from that standpoint, I think barring the dollar actually continuing to fall, which not sure it will. I think it'll steady here. I think looking at an environment where, yes, will inflation stay above the 2% target? I think that's probably the case, but I don't foresee inflation moving higher. So that, I think, is a positive. So I think on the long end of the curve, you're probably going to make the coupon, maybe not at further capital appreciation. But if you do get the 50 basis point cut, that steeper yield curve is going to be panacea to a lot of the regional banks who are going to benefit from an increased net interest margin, be able to improve their lending capabilities. So all this is very positive. And I think if we look out to 2026, I think people are going to be surprised how robust the economy actually is. And again, all that's going to lead to, again, I think a rethink within the market, maybe get rid of the style distortion that we've had in the market, as well as be a very positive thing. But remember, the stock market doesn't always equal the economy from that perspective. So it might be an environment where, because we're so top heavy in the stock market, that the indices don't move very much, but there's a lot of money to be made in other areas of the and people who are fearful of both the dollar falling further and the back end coming up significantly higher might be disappointed if they are leveraged in those trades.
James, I want to get your take on how politics could end up impacting the markets, whether we're talking about a government shutdown or Fed independence. Obviously, we have this funding deadline of October 1st. A meeting tomorrow at the White House, maybe things are resolved in such a way to avoid a government shutdown. But assume for the moment that one does occur and it's protracted. Talk to me a little bit about the way in which politics has the potential to influence a lot of the price action, whether we're talking about the equity side or in the bond market.
Yeah, I think that is, if you think about what could derail kind of the positive scenario that I've just laid out, it's politics, and probably more so geopolitics. Now, clearly what we're talking about in terms of a government shutdown, and I actually think that the chance of a government shutdown now is probably greater than it's been in the past. Usually you can dismiss it as just mere theater between the two parties, but I think both sides have kind of dug in their heels here. So having some type of shutdown for a week, a month, 2 months, whatever, I think is positive. But remember, the DOGE cuts and other things have already led to a large curtailment, at least in terms of the growth of the government. So I don't think it's going to have the same impact in terms of employment that we've seen in the past, particularly when you think about what's occurred over the Obama administrations, where government has grown significantly. But I think one point that I do want to raise is that, people do forget, and this again goes back to the divorce between the economy and the stock market. But if you go way back to like 2002, the economy had turned up, and was doing reasonably well, but the stock market had one of its worst years ever, even small caps. So geopolitical risk at that point in time, obviously, was the tension in the run up to the war with Iraq. And the continued derating of tech stocks. So people, I think, sometimes remember sometimes the economy can do reasonably well while the stock market does not do so well, and frankly, vice versa.
I'm curious to get your take on the labor market, because if there is a government shutdown, the president has threatened to begin laying off government employees. We mentioned earlier that we have non-farm payrolls data due Friday. On Tuesday, it's the job openings data from the government. Give me your sense of how you understand the labor market right now.
Yeah, I think essentially it's been at a point in time where, people have been warning that we're on the verge of a hard landing. But, typically to get into a hard landing from stall speed, which I would argue we're kind of coming out of to a certain degree, you need a shock. And when I look at essentially what the government shutdown could be in terms of a magnitude of a shock to demand, I don't foresee that to be enough of a demand shock to actually reverse the course that growth is actually starting to firm up ahead. And leading indices from what we look at, aren't indicating any type of picture that indicates recession, an inflation spiral, or even stagflation ahead.
All right, James, we'll leave it there. It's always a pleasure. Thank you so very much. James Abate is managing director, also the head of fundamental strategies at Horizon Investments, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Markets in the Asia Pacific are somewhat mixed after China reported strong industrial profits over the weekend. For more, we heard from Sian Fenner, head of business and industry economics at Westpac. Sian spoke with Bloomberg's Avril on the Asia trade.
Give us your thoughts on the data over the weekend out of China. Industrial profits maybe buck some expectations of a decline. How much to you do you think is meaningful signs that the government's efforts to tackle overcapacity are seeing effect?
Hi. I think it's probably a little bit too early to say that the policy that they've undertaken is actually having a true effect. The reason I say this is that it's quite volatile from month to month, and as the Stats Office themselves said, it is actually partly that big jump that we saw was due to base effects. Coupled with that, we also had sort of some bring forward in tariffs. So it's something that it's positive, it's moving in the right direction, but we've got to see about some longevity of whether or not it's going to persist.
All right. We are also keeping tabs on the situation in the US. I mean, the problem now is that even the data that, for example, the bond market is going to be focusing on, that could be disrupted. How do you assess the U.S. economy when, the data that's incoming, that's crucial for markets, might not come in as expected?
Yeah, I mean, I think that's a real thing about this sort of shutdown. Obviously, it has implications both in terms of growth, the short-term impact. Every week, sort of a rule of thumb takes off about 0.1 off that quarter. You can get some bounce back, but I mean, it's the data. So particularly, we are in a situation where we're wanting to be, sort of analysing, how are tariffs actually feeding through into inflation, and of course the labour market. We saw back in 2013, it was 16 days for a total shutdown, and that saw delays both in terms of the non-farm payrolls and inflation data going forward. So it's not just whether or not we'll get Friday's data for the non-farm payrolls, but could we actually even, not actually receive the inflation figures as well.
That being said, we did get PCE numbers pretty much in line. How much do you think this gives economists the focus to look at, the path of inflation and how that informs what the Federal Reserve is going to do?
Yeah, so I mean, I think, the data we've been seeing, I mean, it's a bit of a conundrum really, because I mean, we've got on one side, I mean, it's backward looking, but, we have had strong GDP upward revisions. Monthly household spending is also running at a fairly solid rate, although that was with a drag on the sort of the savings rate. So households are pulling back, are drawing on their savings. How much more can they do that ahead? If we've got inflation rising, as we, expect, their purchasing power is going to decline with tariffs, combine that where you've got that softening in the labour market, you're not getting those new jobs. And it does sort of suggest that, the headwinds for consumers going ahead is rising.
It's interesting because that backdrop that you just highlighted could also apply to Australia. I mean, hotter than expected inflation and then potential weakness in the labour market. How are you expecting the RBA to evolve when it comes to its signalling to the markets?
Yeah, so I mean, firstly, I think if anything, that sort of little hotter sort of partial inflation reinforces our sort of long-held view that September was going to be the RBA remaining on hold. It's probably going to be unanimous. I think really people will be sort of looking for exactly, as you said, that signalling. I suppose a couple of things I'd sort of add to that. First of all, this is a partial indicator. The RBA has signalled that they, while they will take note of this, it's not, they want to see a full quarter. And with that, we also expect that there's probably going to be some payback in September. So while September quarter as a whole may be a little bit hotter than the RBA's forecast, as we move into, the December, we're actually expecting that to come down a little bit. And going forward, we still see inflationary pressures as being such that the RBA doesn't need to keep rates at sort of this sort of slightly, tight at 3.6, and further rates cuts are ahead.
Sian, what about the tariff risk? Because last Friday was a reminder, given the headlines that came through from Trump, of this very risk. We saw, the impact on the Indian markets, for example, and this is also an economy that has quite squarely been in the crosshairs of the US president. Now with these threats of pharmaceutical tariffs, how at risk is the Indian economy, and to what extent can perhaps more dovish monetary policy from the RBI, which also meets this week, offset some of that?
Yes, so I mean, India has definitely been in the crosshairs with that 50% tariff, and now, also with visas where, they're sort of, heavily involved for US, and now the pharmaceuticals. I suppose there's a couple of things. First of all, this is a post, so we're still waiting for a little bit of details there, and also whether or not, at the moment, there's some carve-outs, if you like, in pure Trump fashion. So carve-outs for those that are actually, breaking ground or have construction underway, and also those that are, if it's a generic good. And for India, that matters because most of their pharmaceutical goods to the US are generic. That said, clearly this is a headwind, particularly the longer that these tariffs of 50% remain for the Indian economy. But there's some offsets as well. So they've also had the GST cut, and that will provide some boost for consumers. I think for the RBI, we're looking for them to keep rates on hold. It's probably probably going to be a tight, sort of a live call, if you like, because inflation is low. But we're looking for them to remain on hold this week. But we do see that they do have the space if we do see that these tariffs remain in place at 50%, and consumption, particularly after Diwali, maybe if that fell off, that they will actually provide some more support.
Sian, great to chat. Thanks for setting us up for this week. Sian Fenner, Head of Business and Industry Economics at Westpac.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.